Hi, I'm Ben Rogoff, manager of the Polar Capital Technology Trust. As you can see from the slide, the Trust enjoyed a remarkably strong financial year. Our NAV per share rose by 45.5% during the year, reflecting a strong backdrop for technology stocks, although this did slightly trail our benchmark, which advanced by 46.4%. Our share price trailed our NAV, as a small premium that existed at the end of fiscal year 20 was replaced by a small discount at the end of the last fiscal year. Now, since then, the sector and the Trust have continued to make further progress, with the Trust net assets recently surpassing £3.5 billion. However, the discount has continued to widen, resulting in more limited progress in share price terms since the end of April. Now, although wider discounts are not unique to PCT, the company has stepped in and repurchased a little more than 500,000 shares since the end of April in order to better match demand and supply for the stock. Looking at the year in a little more detail, fiscal year 2020 saw global equities make strong gains as the unprecedented challenge posed by COVID-19, not just to markets but to humankind, was met with unprecedented response from global policymakers, while the global economy, enabled by technology, proved more resilient than some feared. Technology stocks enjoyed an outstanding year, reflecting the critical role they played during the pandemic, strong earnings progress, and more valuation re-rating. After a sharp, if brief, rotation back to value during the spring, a slightly less certain recovery trajectory and lower risk-free rates has recently seen technology stocks bounce back towards their relative highs versus the market. In terms of our own performance, we trailed the benchmark by 0.9%, but this largely reflected the drag associated with liquidity, cash held within the portfolio, and Nasdaq put options, both designed to reduce our downside exposure in the event of a setback. At the stock level, our core investment themes mapped very well to the COVID crisis, and we outperformed in every region and market cap tier during the year. That said, software stocks, one of our favourite groups, lagged as valuation compression somewhat offset earnings and revenue growth, while internet and semiconductor stocks performed better amid recovery hopes. Hopefully, you're familiar with the technology team here at Polar, which we continue to invest in. During the year, I'm delighted to say we added Patrick Stuff to the team as an analyst, which now takes us to 10, one of the largest and most experienced teams in Europe, if not the world, while assets have reached $15 billion across the 3 technology funds and trusts that we manage on behalf of our clients. Our investment approach hasn't changed. It's a combination of top-down and bottom-up. We apply a dynamic definition of what a technology company is and then seek to identify the key investment themes by meeting with companies, analysts, and industry experts, which should also keep us out of trouble and avoid us from investing in last generation winners. We then try to identify the very best ways of getting that thematic exposure into the portfolio while remaining disciplined in terms of valuation. We've said it before, but it's worth remembering that we see ourselves as growth investors, but not growth at any price investors, and we continue to avoid blue sky, early stage, and so-called binary investment. We then construct the portfolios with an eye to the benchmark and apply self-disciplines learned over many years intended to ameliorate the risks associated with technology, obsolescence, misexecution, valuation compression, and of course, hubris. Many of you will have seen this chart before, but it's a great reminder of how not only do we look to identify themes, but invest in them during their adoption sweet spots, which we believe is somewhere between 5 and 30%. Now, often that's when stocks look expensive, but where earnings estimates can be wrong for multiple years. Conversely, we avoid blue sky and early stage investment because often it takes longer for mainstream adoption to happen. And it's another reason, of course, why we tend to avoid companies which require ongoing capital. We also continue to avoid mature legacy tech companies that, using a traditional valuation toolkit, often look cheap on forward PE or free cash flow yields, but in our experience, rarely are. Now, it's been said that you only have to make a few good decisions in your life. Well, for me, one of those was focusing on the technology sector first as an analyst in the 1990s and then later as a fund manager. Now, the early part of my career, the sector became infamous during the bubble and the bursting of that bubble in the late 1990s. But on the eve of the pandemic, 7 out of the top 10 companies in the world by market cap were technology companies. The sector delivered on that early promise, and it was also responsible for most, if not all, of the growth in equity earnings post the great financial crisis, as technology disruption, we've discussed this before, driven by the internet, the cloud and smartphones, created new markets whilst disrupting traditional profit pools. And then COVID happened. Much has already been written about the digital transformation imperative and the acceleration that we've seen in technology adoption. But amid the lockdown, and with offices and shops shuttered, technology adoption has not just accelerated, but we've seen it deepen and broaden. And hopefully a few examples will make this acceleration clear. E-commerce, which has been a long-term investment theme for us and had been gaining share at the expense of offline retail at maybe 1% a year, more than doubled its share of the market almost overnight. The cloud, long in our minds the default platform for compute, grew unabated against a backdrop of declining IT budgets. Video conferencing finally became a mainstream technology, having been a business tool and frankly niche market for more than 20 years. Telemedicine stepped in to fill the void, while electric vehicles boomed against a backdrop of declining auto sales. But more important than that, in my mind, the pandemic has resulted in a new work modality, so-called hybrid work, and it's probably marked the end of the office-based era, which, based on the rise of coffee shops and so-called third places, was already creaking pre-pandemic. The democratization of the means of production, which in today's world, of course, means smartphones, laptops, Wi-Fi and cloud software, was really the precondition for this new work modality. While the pandemic has ended up becoming a unique proving ground, really, for not just a myriad of new technologies, but also a different way of working. And in our opinion, hybrid work represents the best of both worlds. The efficiencies and focus of a remote working model, but also the social interaction, the culture and serendipity of the office. Our excitement about the concept of a new work modality is why we focused on it so heavily in our annual report this year. We believe it's going to outlast the pandemic and prove the foundation for the next wave of technology disruption. Hybrid work is going to have a profound impact on cities and office space. On a prosaic level, COVID has proven, in a way that really only a crisis can, that companies can get by with less office space, particularly when it's in expensive locations. As the US unlocks, it's striking, I believe, that vacant office space in San Francisco is still at record highs. In London and New York, workplace activity still remains less than half of where it stood pre-pandemic. And recently, Apple announced that it wouldn't ask its staff to return to offices before 2022. Deurbanization looks set to continue, while lower commute volumes are likely to continue to pressure mass transit systems, critical, of course, to cities. International travel is likely to remain constrained, bad for the global economy for sure, but worse for cities like London, that pre-pandemic actually accounted for more than 50% of the total spent in the UK by international visitors. Now, we're all hopeful, of course, that in time, international tourism will recover, but business travel may not. And I think we've all experienced, Zoom and other video platforms and their ability now to fill that gap. And of course, they are far less environmentally damaging than international travel. Internal travel, which, believe it or not, accounted for 40% of overall business travel pre-pandemic, may forever be lost to virtual alternatives. And the same may be true for cross-border business events, like trade shows. Globally, the business events industry is worth more than $1 trillion in direct spending alone, and, in my mind at least, looks ripe for technology disruption. Of course, cities won't go down without a fight. More than half of the world's population live in them after all. They'll try and come back cleaner, greener and fairer. All good news, I suppose, for electric vehicle companies and for alternative energy. And as for the office of the future, well, we suspect that they'll be for meeting clients and building culture, and will look increasingly like technology company offices. While the threat posed to cities and offices is mostly about what not to hold, in our opinion, within our own portfolio, we have exposure to electric vehicle companies like Tesla, VW and BYD in China, as well as a collection of semiconductor companies. Our holding in Airbnb is benefiting not only from the growth in domestic travel, but also from remote and hybrid work, with 19% of stays booked on its platform during Q2 for 28 days or more. Hybrid work is also having a profound impact on our homes and where we live. More time at home may, ironically, have saved the high street, where I suspect that each of us will consume more services in the future at the expense of city centres. More time at home also means larger delivery windows, more direct to consumer, the ability for brands to disintermediate retailers and go direct to consumer, more e-commerce overall. It also means different activities, especially those that require time at home, such as pet ownership, cooking for pleasure, playing golf, learning remotely, and participating in home fitness. It also means weekend life is likely to become less home-centric, more active, more outdoor. Within the portfolio, we have exposure to this via a slew of e-commerce companies, video gaming stocks, over-the-top video and music platforms, as well as home CapEx beneficiaries, such as Sonos, which just grew its revenues 52% year over year in its last quarter, and meal kit provider HelloFresh, which saw its orders grow more than 70% during Q2. The new work modality is also likely to transform the nature of work. And this is likely to prove the most important and longest-lasting change post-pandemic, but is probably the least obvious today. During COVID, remote work abstracted work from the workplace in much the same way that software virtualization abstracted compute and storage from where servers were once physically located, which we now know was a precondition for the architectural shift to cloud computing. Well, before the pandemic, we had thankfully broken the link between paper and information, but we still relied on paper-based records. Now, of course, remote work ended that status quo because we needed to be able to access those files from anywhere. The growth in cloud workloads during the pandemic is testament to this, but in time, hybrid work should presage a wave of process automation, stratification, and digitalization. And just like this video, our interactions should become increasingly digital, which should hopefully at least obviate the need for paperwork, while unitizing work and making it more measurable. In time, this should see our data sets explode in size and accuracy, providing the foundation layer for artificial intelligence and, we believe, the next wave of technology disruption. Within the portfolio, we have exposure to this via the public cloud companies themselves, Google, Amazon, and Microsoft, as well as video and communications companies like Twilio and Zoom. We also have exposure to software platforms such as HubSpot that help companies acquire and retain customers, and companies like DocuSign and ServiceNow that automate business processes. We also have some exposure to collaboration businesses like Atlassian that help orchestrate work, critical in a hybrid work modality. We are also hugely excited about what this new work modality might mean for productivity, which at 1.3–1.4% per annum has frankly been lackluster since 2004. We think that one of the ways hybrid work could help is by increasing the female labour participation rate, as flexible work should obviate the traditional trade-off between family responsibilities and career progress. We should also see less unproductive time and days lost due to less commuting, less business travel and better scheduling. But more importantly, we believe that remote work, automation and AI could transform service sector productivity via better stratification of work and the scaling of labour. A good example of this is telemedicine. While a remote or virtual appointment saves a little money, it saves a lot more time. Actually 13 minutes for an appointment versus an all-round trip to an in-office appointment in the US of more than an hour. Together, with remote monitoring, we believe telemedicine has the potential to massively reduce the cost of chronic disease management. In fact, a study by the Veterans Association suggested that the combination could save more than $300 billion a year. Telemedicine should also help reduce unnecessary referrals. Kaiser Permanente used it to resolve 70% of dermatologic cases within 5 minutes and to solve 40% of all patient problems. Now I'm going to quickly spin through our core investment themes and quickly update you with thoughts on each. E-commerce has been obviously a massive beneficiary during the lockdown, with certain categories within it, like grocery and food delivery, benefiting disproportionately. While the largest platforms like Amazon did well, it was the smaller ones like Shopify and Etsy and Zalando which really benefited from the increased relevance, the larger audiences, and of course the greater engagement that helped them reach critical mass earlier than forecast. However, more recently the group has fared less well, because of reopening and weaker consumption trends and more difficult comparisons, frankly, that have weighed on growth during the second half of this year. This was recently evident at Amazon, that missed quarterly revenue estimates for the first time in 3 years and issued weaker than expected guidance. Our position in Amazon is at the lowest level it's been in some time. Thankfully, weaker trends are less evident elsewhere, particularly in Asia, where lower vaccination rates and the Delta variant have constrained the pace of reopening. Delta has obviously also weighed on the travel vertical, an important one for e-commerce, where recovery is being hindered by constraints on international travel that sadly we think are likely to persist for the foreseeable future. That said, we still like the medium-term story. It's one that should continue to take share from the offline world while benefiting from that hybrid work modality. Having said all of that, we have reduced our exposure to our Chinese platform plays, Alibaba and Tencent, two stocks we've held for a long time, as a result of not demand weakness but regulatory change in China that frankly began last November with the aborted Ant Financial IPO. And since then, we've seen the Chinese government intervene in a number of different markets, including education and food delivery, while becoming overall less market-friendly, looking for companies to take on more social responsibility. Obviously laudable, but unhelpful as shareholders for corporate profits and very negative for valuation and investor sentiment. In contrast, the regulatory backdrop for the largest of the US internet platforms has proved relatively benign. Of course, challenges remain, and these are multi-year in nature, but unlike in China, we're comforted by the fact that there exists a well-understood legal process. In fact, a recent setback experienced by the FTC in its antitrust case against Facebook was a perfect reminder of the robustness of this process. That said, Facebook and Google both fared relatively poorly early in the pandemic as weaker advertising trends caught up with both advertising-based platforms. However, economic recovery has led to a sharp rebound in overall advertising spending, with growth this year forecast at between 12 and 13%, more than twice that estimated for global GDP. Online advertising should, as it has in the past, continue to outgrow the overall industry, while Google and Facebook have done better still, both growing advertising revenues by more than 50% year-on-year each in their recent quarters. While Snap, a holding of ours and the Gen Z social media platform of choice, grew revenues more than 100% year-over-year last quarter as brand advertising snapped back. Now, we've held both Google and Facebook since IPO and acknowledge that regulatory risk is going to remain an overhang, but both are core holdings for us that trade at relatively inexpensive forward valuations, particularly when you adjust them for their growth. The software sector remains a key favourite of ours too, for many reasons. The move to cloud has seen companies adopt a subscription model that has significantly improved their financial visibility, while at the same time significantly growing the addressable market by allowing small and mid-sized companies to access applications, tools and platforms that were once enjoyed only by the largest companies. The move to cloud software, or software as a service as it's sometimes known, is one of the most powerful and least known stories in my mind of financial inclusion in recent history. The pandemic has taken software to a completely different level, demonstrating of course its criticality and turning long-held digital transformation strategies into operational and tactical emergencies. Now, within the portfolio, we hold a collection of exciting next-generation companies focused on automation, communication, and collaboration, all categories that we believe are well-positioned relative to hybrid work. Microsoft remains our largest software position today, thanks to its dominant position in office productivity software and its burgeoning cloud business, Azure. In addition, the pandemic has seen Teams become a key communication platform with over 250 million monthly active users today, which we believe positions the company well for a hybrid world. Now, while software remains a favourite area for us, our enthusiasm is somewhat muted by sector valuations that are somewhat elevated. As such, and this is probably always true, there are a number of next-generation software companies that we would love to own, but that we don't today because their valuations appear to us, at least, to already capture significant future growth. As I mentioned earlier, we are growth investors, but not growth at any price investors. Like software, the cloud remains a long-term favourite of ours. We have held a position in Amazon ever since we first identified AWS, Amazon Web Services, as a key way of playing the growth in public cloud computing. Likewise, Microsoft, once a PC play, has pivoted beautifully to the cloud, leveraging its incumbency to remain relevant in both applications and infrastructure, indeed a rare feat within technology. As the pandemic saw companies accelerate their digital transformation strategies, the cloud sat as the infrastructure layer beneath this acceleration in adoption and innovation, delivering incredible resilience and scalability. IT budgets may have fallen sharply last year, but the three cloud titans, Amazon, Microsoft and Google, delivered $77 billion of cloud revenue, up 38% from the prior year, and this year should collectively surpass $100 billion. Cloud penetration at just 23% of overall workloads should support growth for many years to come. In addition, we continue to favour security stocks, particularly now that the pandemic has significantly increased the so-called attack surface due to new devices, new data silos, and of course the exponential growth in data traffic. This heightened risk was evident recently in another high-profile hack known as Sunburst, and helps explain why cybersecurity is the number one IT spending priority this year. Within the space, we're particularly excited about zero trust, identity and access management, and container protection, although our position sizes in next-generation leaders like Cloudflare and CrowdStrike reflect their elevated valuations. An early beneficiary of lockdowns and stay-at-home orders, the digital entertainment theme has experienced more ups and downs than many of our other key themes during this pandemic. Early winners like Netflix and Spotify, both household names and small positions in our portfolio, together with the video gaming industry, have recently struggled to maintain that earlier momentum, with user growth or engagement slowing, suggesting that pandemic games might have been more pull forward than structural in nature. Now, this narrative is difficult to fully dismiss, particularly as lockdown restrictions end in the US and the UK. But we continue to see the digital entertainment theme as secular in nature, benefiting from smartphone ubiquity, favourable demographics, mass personalisation of content made possible by AI, to name just a few of the drivers. We also remain excited about the long-term potential for the so-called metaverse. These are platforms for shared online experiences where people can interact in virtual environments to play, learn and work. This emerging theme has benefited greatly during COVID, of course, because of the lack of physical gatherings. Our position in Roblox reflects not just its potential today, but its future potential as a creative gaming platform where content development is constantly evolving. That said, with reopening and difficult comps ahead, resulting in slowing growth, we have reduced our overall exposure to the theme modestly, which we fully expect to rebuild once those comparisons get easier and/or if our confidence in the reopening trajectory falters. Data economy and AI is largely comprised of cloud companies that offer storage, compute and AI as a service, as well as a collection of semiconductor and semiconductor equipment stocks. As I will go on to discuss shortly, we are hugely excited about artificial intelligence, which is actually moving well beyond the R&D stage today after years of fine-tuning models thanks to more domain-specific datasets and performance improvement of dedicated hardware. The rapid industrialization of AI has been particularly evident in the healthcare domain, where a virtual screening or deep docking technique, which embeds the use of deep learning, was used to accelerate virtual screening of 1.3 billion compounds in order to identify 1,000 quality candidate compounds to inhibit COVID. This process was completed in a week as compared to 3 years with previous approaches. This is just one example of how AI can fundamentally change the economics of drug discovery, especially in rare diseases that have not been adequately addressed due to high development costs and low potential returns. We believe that semiconductor and semiconductor equipment companies represent fantastic ways, leveraged ways, of playing AI proliferation as more data is generated, stored and analysed. Today, machine learning compute is said to be doubling every 3.5 months. By 2025, AI-related demand is expected to account for 20% of overall semiconductor demand. With semiconductor companies forecast to capture between 40 and 50% of the total value from the technology stack, we believe that AI represents the best incremental opportunity for the industry in decades. 5G and connectivity also remain an important theme within the portfolio. Infrastructure rollouts that began in earnest during 2020 were not meaningfully delayed during the pandemic outside of China, which we believe speaks to the perceived strategic and economic importance for this cycle. Now, whereas previous mobile generations saw value largely accrue to new applications rather than the infrastructure providers, which, by the way, is why we have very limited exposure to the companies that carry traffic, this may not be true of 5G, where new technologies such as dynamic spectrum sharing and network slicing represent significant incremental content opportunities. We still prefer the content and component suppliers like Marvell and Lattice Semi to the OEMs themselves. In addition, we've got far more exposure to smartphones than base stations, where 5G is expected to account for more than 600 million subscriptions worldwide this year, almost tripling from the level at the end of 2020. 5G handset demand has helped Apple grow its iPhone sales 50% year over year last quarter, while a richer mix of 5G smartphones should help chip companies like TSMC, Qualcomm and MediaTek. 2020 proved to be one of the best years for the industrial automation industry, as the pandemic presaged widespread and urgent adoption of automation technologies, expanding the overall market for IA, industrial automation. A crisis that robots were built for, so it's known, the pandemic has also triggered urgent reviews of supply chains globally and the trend towards so-called nearshoring. In addition, surging adoption of electric vehicles has also helped industrial automation adoption. Although our current exposure is relatively modest, we remain excited about the long-term goal of transforming traditional production lines with the goal of ultimately handling a batch size of one, made possible by integrating machine vision, industrial IoT, real-time analytics and AI. The fintech space looks exceptionally well placed to benefit from ongoing e-commerce growth, the broader acceleration of digital payments, and further penetration of digital technology into financial services. The pandemic saw next-generation companies like PayPal and Square develop COVID-friendly solutions to support their merchants, including omnichannel and contactless checkout, and many were involved in the rapid distribution of government stimulus to individuals and small businesses alike, as incumbent banking infrastructure struggled against intense demand. It also led to an accelerated decline in the use of cash, which had been falling for many years, while the pandemic is said to have delivered 5 years of digital payment market expansion in just 9 months. While e-commerce gains are moderating as expected, payment pure plays like PayPal and Square should, in our mind, continue to benefit from more users, greater engagement, and the development of their digital wallets into so-called super apps. In addition, the prospects of broader fintech disruption have been greatly advanced by the availability of cheap, scalable, third-party financial infrastructure, combined with efficient online customer acquisition, which has prompted a flourishing of innovation and, of course, capital raising. This includes a plethora of exciting fintech trends like neobanks, buy now, pay later, and of course, cryptocurrencies. Whilst these trends will naturally enjoy varying success over the coming years, COVID, we believe, likely marks the breakpoint between the old world of financial services, based on, of course, dominant incumbent banks, and the new world of specialised players, personalised offerings, and finance embedded within other activities. While we're excited about the technology-enabled disruption that we see ahead, we also consider the unique risks and challenges that fintech brings with it, including relatively uninformed buyers, which of course invites regulation, and more significant downside risk associated with experimentation, which helps incumbents. So for now, we'll continue to tread carefully with our fintech exposure, which today is largely explained by PayPal and Square, and is augmented by a number of smaller holdings such as Wise, Adyen, and Upstart. Our final secondary theme is mobility and EV. Given that transportation accounts for almost 1/4 of direct global emissions from fuel combustion, electric vehicles are likely to represent a key part of any green solution. Together with autonomy and connectivity, we believe that electrification represents the biggest revolution in the auto industry since the introduction of the Model T in 1908. As with many other secular trends, the pandemic has accelerated growth, with sales of global plug-in electric vehicles increasing by 43% in 2020 to just over 3 million units. And this represented global penetration of 4.2%, but in certain markets like Europe, penetration surpassed 10%. The outlook looks good to us, with EV penetration expected to reach more like 28% by 2030, supported by numerous countries banning internal combustion engines in the 2030 to 2040 timeframe. We've recently revisited Tesla, actually, after a period of stock underperformance and strong fundamentals, while we continue to hold smaller positions in both BYD and Volkswagen, automakers that we believe are well positioned to benefit from the adoption of new energy vehicles. We have also continued to own several component companies with disproportionate exposure to EV adoption, including Infineon and Littelfuse, as well as some auto-related names in the tail of our portfolio. These core and secondary themes comprise the vast majority of the trust's exposure, and hopefully, as you can see from this chart, is a good reminder of how diversified the portfolio is thematically. And over time, naturally, we look to reallocate our exposure to where we perceive the best risk-reward across those favoured themes. In addition to identifying and selecting stocks within our core and secondary themes, we as a team spend a lot of time considering emerging ones. While we avoid early stage, binary and/or pre-public investments, we use sell-side analysts, industry experts such as Gartner, and company meetings, of course, often with private businesses, to stay informed about the most important emerging themes. Of the emerging themes identified today, of course, the most exciting and important one is artificial intelligence, a view, as this chart demonstrates, seemingly shared by Gartner. This one you've seen before, but the combination of gains in compute power, massive data sets, and incredible progress being made in machine learning and AI should see AI become the most disruptive class of technologies in the future, according to Gartner. Today, many of the leading technology platforms are already using machine learning and AI to generate or recommend or even personalize content, find new customers, better monetize them, and reduce churn. Essentially, those platforms using machine learning to make decisions at a scale and speed impossible for humans. Now, traditionally, the testing ground for AI has been gaming, where engines have been able to frankly achieve superhuman capability in domains like Go, chess, and more recently, poker. However, 2020 saw progress in the healthcare domain when Google's AlphaFold solved the 50-year-old problem of predicting protein structures from amino acid sequences. And, as we've already discussed, deep docking helped vaccine efforts by greatly accelerating the time taken to identify candidate compounds. We have also seen incredible progress made in the field of natural language processing, a critical battleground given its disruptive potential. Transformer-based generative language models are now capable of completing sentences, responding to questions, and are able to summarize an article. In early 2020, Microsoft's Turing NLG was able to achieve 98% grammatical correctness using 17 billion parameters. That looks old hat now. Google has a model that can be trained using more than 1.5 trillion parameters. And we've begun to see early evidence that AI is capable of actually creating content in gaming, art, and prose. Now, while we might in time look at these early efforts like cave paintings or 8-bit computing, they provide us with some pretty compelling evidence of the power of TNLGs and adversarial neural networks. Turning briefly to valuations, you can see that the technology sector today trades at its highest forward PE rating since 2004. However, these elevated valuations largely reflect the upward re-rating of US stocks and, frankly, equities in general since the financial crisis low. On a relative basis, we're heartened by the fact that the US technology sector continues to trade within its traditional boundary of between 0.9 times and 1.3 times the market multiple. However, the same cannot be said for some next-generation stocks that remain elevated, with the exception of internet stocks, actually, whose valuations have fallen back into their historic range as measured by a forward EV to EBITDA multiple. While software valuations have somewhat contracted, they still remain elevated relative to history, reflecting a number of factors, some good, strong fundamentals, increased relevance post-COVID and M&A, and some perhaps less good, depressed risk-free rates, passive investment trends, and possibly retail participation. As previously discussed, these elevated valuations in favoured groups like software and the spread shown here between cloud and legacy valuations help explain why our portfolio today is perhaps a little more conservatively positioned than is typical. In terms of the portfolio, we do remain heavily skewed towards US companies, with increased exposure coming recently at least at the expense of our weightings in China and Japan. And our cash level remains a little higher than normal, reflecting that slightly less certain recovery trajectory thanks to the Delta variant, elevated valuations, and tail risks associated with geopolitics, inflation and regulation. However, let's not forget we remain 94 to 95% invested, and our shape remains pro-growth, reflecting the strength of our fundamentals and our heightened relevance in a post-COVID hybrid work world. While our top 10 holdings remain dominated by the best that our benchmark has to offer, incredible companies including Apple, Facebook, Google and Microsoft, our active share is explained by smaller positions in a number of next-generation companies across our themes, as well as a large number of zero positions in index constituents that we actively avoid. While our market cap exposure looks relatively flat versus the index, this largely reflects a static cutoff for small and mid-cap stocks. However, when we apply updated cutoffs to adjust for market movement and introduce a mega-cap band as shown here, it should be clear that we remain significantly underweight the very largest companies and in aggregate, overweight everything else. Finally, a reminder of how we bring this all together and how the portfolio stacks up versus the index in terms of valuation and growth. In contrast with peers of ours that are built around large concentrated stock or thematic bets, PCT remains a truly diversified portfolio designed to outperform the index by delivering growth in excess of it for a small valuation premium. At the end of July, that premium was about 20% in terms of forward EV sales, while the portfolio was expected to deliver nearly 30 to 40% more growth next year than the index. So in summary, while we acknowledge that there may be some signs of exuberance in portions of the technology market, which by the way we'll try our very best to avoid, we remain hugely excited about the prospects for our industry. The pandemic has proved an incredible accelerant for technology adoption and a proving ground for a slew of new technologies. And combined with the rise of a new work modality and with AI moving into the mainstream, we think the outlook for technology has rarely been brighter.